Once again, St. Louis, welcome to What Retirement Means to You with Jerry Means. He's a financial advisor, the founder of the Means Financial Group. I'm your host, Spike Spangle. Jerry, how are you doing this week?
I'm doing fantastic as always, Spike. How are you?
I'm doing very well, On today's program, we're going to be talking about retirement news or noise. There's so much that we're hearing about today, everything from high inflation to the markets going all over the place, and Jerry's going to help us sift through what you should be paying attention to, what you shouldn't be paying attention to, and where do you look for advice, especially when it comes to retirement. A lot you packed into this show, buddy.
Yeah, absolutely.
So let's hop into this. The first thing I've got is something that's teed up. Jerry doesn't even know that I have this. I pulled this out. There was a new study that was done by Vanguard. And you know that Vanguard is more of a do-it-yourselfer kind of investment house. Mm-hmm. And Vanguard was asking the question, do you make more returns by working with a financial advisor or by doing it on your own? Because I think most people think that if you do it on your own, you could save a little bit of money, like going to Home Depot and remodeling your own bathroom, right? Yeah. Every time I've tried to do something like that, I spend 4 times as much money and hours, and then I have to get a contractor anyways to come fix it.
Multiple trips too, by the way.
Multiple trips, you got to buy tools, you got to get all this stuff. What this independent study found was that by using a financial advisor, you can actually double your own savings over a 20, 25-year span just by making an extra 2 or 3% by working with an advisor. Do those findings surprise you?
100%. I mean, I've seen it myself. You know, we've been spoiled with the last 12 or 13 years of the market, right? Since 2008, the markets have been generally calm and doing very well. Actually, it was one of the greatest bull markets that we've ever seen. Mm-hmm. You know, we had a little blip during the pandemic, but in 2022, it was a wake-up call. You know, people got reminded that the market does not just go up. And it's funny because I go to a lot of business conferences, and you know, I'm still doing continuing education and things like that. And I go in and I meet some of these advisors that have only been in the business for 8 or 9 or maybe even 10 years. They've never had to deal with the diversity that we've seen last year. They've been in a steadily climbing environment in the market. I've been in the business for 2 decades, so I've seen the dot-com crash. I've seen the 2008 financial crisis. So I've seen the roller coaster before, and when I was younger, I was a fan of roller coasters. But as I've gotten older, they're a little rough on my back. You know, body can't take it anymore. And I think that's what happens when people get near retirement. Is they don't want that roller coaster. And part of smoothing out the ride can be getting some help and not trying to do it all on your own, and having someone kind of coach you through the emotional part of it, because money is emotional. We like to say we don't get emotional about money. Money's not the most important thing, which is true, but it definitely is emotional. And a lot of times in my office, whether it's existing clients or new clients coming in, part of my job is really, the numbers are all important, but part of it's just letting people know they're going to be okay, not letting them make knee-jerk reactions. That, hey, we have a plan in place in case this happens. If you have the right financial plan, you're going to be okay when that roller coaster dips sometimes.
Right. This Vanguard study, independent study done, that says that if you can earn just over 3%, an extra 3% in your returns, you can double your own savings. What they did is they took $500,000. They studied it for over 30 years to see what happened if you invested on your own and if you were investing with an advisor. And in that 3% of returns is exactly what you were talking about. 1.5% of the 3% was for the behavioral coaching. Can you tell me, what were you doing? What kind of conversation were you having with clients in 2020? Remember in March, the markets were going down once again, 30%, just like back in 2008. What were the conversations you were having?
Well, you have to remember, we've all heard the expression fear and greed, right? And you have to be careful that people aren't too fearful and they aren't too greedy. It's a tightrope that you have to walk. So part of my job is telling people, okay, we want to have money in the market. We want to be invested for the long term, but we don't want to take any undue risk because, again, I work in the retirement market. I'm working with people who are nearing retirement or already retired. They've already hit the home run. They've won the game. Now they just want to keep what they have, figure out how to draw income off of it without losing half of it in a market like we've seen last year. If last year continues into this year, we don't want another year like 2022 in our portfolio. if you took a big hit. And one of the things people will call and come in and say, well, I'll say, how did your portfolio do last year?
Right.
And they'll say, well, it didn't do that great, but no one really did great. That's not absolutely true. There are portfolios that were flat or maybe positive 2 or 3% last year. Well, if the market was down, or if you were down 18, 20%, and there was a portfolio that was even just flat or only up 1 or 2%, that's outperforming the market by 20%. That might be worth paying a financial advisor if you're getting the service. So paying a fee is not a bad thing, but are you getting the results? Are you getting the communication? And are you getting that coaching?
Right. Another 1% of this 3% that they talked about in this Vanguard study, that by using a financial advisor, you can actually increase your returns. Independent study. This isn't coming from Jerry Means. This is from the large firm Vanguard. 1% for income planning and withdraw order. This is something you've talked about before. This is part of putting together the income plan. Does it matter, and how does it matter when taking out money for your income stream in retirement? Do you take from tax-deferred accounts? Do you turn on Social Security first? Do you take from those possible Roth accounts? It seems to make a difference, even that 1%. How do you do it? How do you do it with your clients?
Well, first I have to really get to know the client, what they're wanting to accomplish, what all of their assets are. I'll ask, do you have an income plan or a written income plan? Most people don't have a written income plan. That's what I want to provide to them. But they'll say, yeah, I have an income plan, we have Social Security, and we have a pension. I go, okay, well, how much do you have in assets? Well, we have $2 million. Okay, well, do you know that you're going to have to take required minimum distributions off of those? Maybe we start taking distributions now while we're in a lower tax bracket so that you're not having to take such a big chunk all at once when you turn 72 or whatever they bump the new rule to, right? Now they're talking about it might be 73 or 75, right? So we can tell them, listen, you need to know which bucket to pull those assets from, and we want to look at the tax strategy to do that. You might not want to wait until you have to make a distribution. For other people, it makes sense to keep that money tax deferred and not draw it until they have to. It's different for every situation. So it comes down to really getting to know what the client's wanting to do, what their situation is, what their different income sources are, and what different types of assets do they have. Is it all pre-taxed money? I have lots of people that come in, they've just been funding that 401k or that 403b. So they were very studious with their money. They were really good savers, but they didn't diversify the tax buckets. They had stocks and bonds and mutual funds, but it was all in pre-taxed accounts. Now when that money comes out, it's all taxed as ordinary income. You want to make sure you have some Roth. You want to have that TOD account or that transfer on death individual account, so you're only paying capital gains tax. So you want to have a blend. So I help people make sure that not only asset allocation is just stocks, bonds, mutual funds, but we want to look at the different tax buckets as well.
Can you and your firm help somebody with that? So let's say, we've drank the Kool-Aid for the last 3 decades. We've been saving in tax-deferred accounts because we get that tax break this year on our income. So a lot of people have a majority of their life savings in tax-deferred accounts. Can you help them walk through that, how to change it over to a Roth?
Yeah, and that's one of the things that we do when we do the on-track review. And we're going to offer that to the next 10 callers. If you come into my office, it's no cost, it's no obligation, there's no pressure. I'm going to sit down and get to know you. We're going to look and say, okay, what is your income plan? And if you don't have one, we're going to help you design a written income plan, something that you can refer back to and make sure that you're staying on track. We're also going to look at the tax planning. We're going to look at longevity, make sure you have the right health care plans in place. We're going to look at long-term care. And we're going to look at income planning and tax planning together cohesively. So give us a call, 844-878-1293.
Thank you so much, Jerry. We're going to take a very short break. Folks, call the phone number so you could get your own on-track review from Jerry Means of the Means Financial Group. We're going to continue to talk about what's in the noise and news right now going on with retirement planning. But call 844-878-1293 so you can get your own complimentary on-track retirement review. More of what retirement means to you right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to What Retirement Means to You with Jerry Means. I am your host, Mike Spangle. We're doing news and noise, retirement planning topics that are out there right now, and I want to know from you to help us sift through the news and noise. What is important? What do we need to be paying attention to? We just talked about how financial advisors using one can actually increase your gains. This was an independent study. Now I want to move on to this. Jerry, I want a hard answer from you this time. You're always saying it depends. I want to know right now. Do we take our Social Security and let our investments grow? Or do we take from our investments and let our Social Security continue to grow? Which way? Do you have a stance at your firm on Social Security?
So Spike, I'll answer that question. I'll give you the hard answer if you can give me a hard answer.
Okay.
How old are you going to be when you pass away?
I don't know. I don't know how to answer.
So it depends, right? It depends.
Okay.
I can't help you with that.
Yeah.
What we can do is we can look at all of the different income strategies that you have, because it is different for every person that comes in. There is no hard, fast answer. Now, we know deferring Social Security to age 70, it doesn't grow anymore after age 70. So
Okay.
if you're age 70, you haven't drawn it yet, start taking Social Security. If you want to get the biggest paycheck from Social Security, if that's all you're looking at, age 70, right? It just doesn't grow anymore after that. But people will say, yeah, but my dad lived to be age 82 and my mom lived to be age 85. So I'm thinking if I take it at 62, I have all those years of growing it. Doesn't mean that they're going to live to be age 82, right? We just don't know. So there's break-even points. So if you mathematically want to look at it and you know when you're going to pass away, I could answer that question and say, okay, if you die before age 78, it made sense to take it early. If you live past age 78, you would have been better off deferring. But no one knows the answer to that question, just like you didn't.
Okay, all right.
So we have to do some planning. We have to look at how much assets do you have in your 401k? Do you have a pension? Not everyone has a pension anymore. Is there a spouse involved, right? What's the age difference between you and your spouse? Is it either one of you in bad health? Because sometimes I'll have a spouse that is the breadwinner, and their Social Security is going to be much higher than the other spouse, and the other spouse maybe is not in the greatest of health, unfortunately. Well, if this spouse is more likely to outlive this one, why not go ahead and trigger that benefit, but keep deferring this one, right? Because if this spouse passes away, they don't get that check anyway. So it can depend on this, and those aren't always pleasant conversations to have. But a lot of times, just like with a doctor, you have to give full disclosure for the financial advisor to do the best job for you. You can't go into an advisor and say, okay, I'm willing to pay the fee to get better results, but I'm not going to share everything with you about my portfolio, right? Or be willing to do some stress testing. We haven't talked about that much on this show, but part of the on-track review is really figuring out, okay, if we live to age 85, what are these numbers going to look like? If we pass away at age 65, what do they look like? Or age 95? And we have to kind of tinker with that a little bit and look at the outcomes to find out what the best plan is going to be.
I think another issue with Social Security is, as we saw from last year, if you have very high inflation, once you turn on that Social Security, it's pretty much locked in. But There is the opportunity for a cost of living adjustment every single year. It's based on the CPI, the Consumer Price Index, and it was very good last year. Does the cost of living adjustment always help you keep pace with inflation with Social Security?
I would say historically it hasn't kept up with inflation. In some years you don't get an increase at all. And I think we all can agree inflation goes up a little bit every year. Things almost always cost more this year than they did last year. We just don't see the big jumps that we've seen previously. And even last year with the increase, it wasn't as much as what the inflation numbers were. So it didn't even keep up. But yeah, it was nice to see that increase, but it didn't help you with, it still didn't make up that gap of what things are costing today. We were talking about going in and buying a carton of eggs and it costing $6.
Yeah.
You multiply that over all of your mug, your mortgage, right? Your utilities, your groceries. You start compound. That was just one carton of eggs. 30 years ago, that carton of eggs was 91 cents. So that means someone that was retired 30 years ago, maybe they retired early at 60 and they paid 91 cents for the carton of eggs. Now it's 30 years later, it's $6. Look at that percentage increase. Their Social Security didn't increase by that much. Their pensions, most pensions are flat. So they had to pull more money out of their assets to make ends meet every month. So you got to make sure that you have enough to do that. And that's where we come in and say, okay, let's address income planning. Let's make sure that we have a budget in there for those inflation needs. Maybe do some things like ladder annuities. I had a client came in and we put about $500,000 into fixed income annuities that they can turn on an income stream. Now, instead of taking $500,000 and putting it all into one annuity contract with one insurance carrier, we divided up into 5 $100,000 contracts. There's nothing that's going to hurt the client by doing that, but there's a lot of benefits to doing that. And so it's a lot of paperwork for me, and the client has to sign a few more times. But once I explain the benefits, they get it. Because I'll say, all right, if we put it all in one contract and we start the income from it, it's an all or nothing. But if we have it in 5 $100,000 contracts, when you come in and say, okay, how are things going? How is your budget? How are things at the end of the month? Well, Jerry, inflation's getting us, we're starting to fall a little short. Okay, do we need to turn 2 of those income annuities on, 3 of those income annuities, 4 or 5? Oh, I think 2 of them will be enough when I show them what the income will pay. Great, fantastic. The other ones are continuing to get bigger. 5 years from now, they come back and say, Jerry, inflation's getting us again. Okay, great. We still got those other 4 or other 3 annuities. Let's turn those on, give you a boost in income again. So we can kind of ladder their income buckets within that strategy.
And within there, so that is now income for life, along with the Social Security, and then you still have the other 401k investments. And so it's really putting together all of this into a plan, not just crossing our fingers or using Social Security. All right, fair enough. I know it's hard to answer for everyone. When do you take it? Please explain, though, I'm going to take a very short break right now. The On-Track Retirement Review, income strategy, how do you help evaluate that inside the On-Track Review?
So what we want to do is for the next 10 callers, if you give us a call, you can come in for the on-track review. There's no cost, there's no obligation, you have nothing to lose, and there's no pressure. Who you see is who you're going to see when you come into the office. I'm going to sit down with you, we're going to have a cup of coffee, I'm going to get to know you. I want to know about your family, what you're wanting to do in retirement. Are you retired? Are you looking to retire soon? What kind of pension plan do you have? What are your Social Security benefit projections right now? Let's talk about that. Do you have a child that has special needs? Do you have an estate plan set up for that? We're going to address all of those things. My practice is focused on people in the retirement red zone. You're nearing retirement, maybe 5 years within retirement, or you're already retired and you want to make sure that you're staying on track to stay retired, right? So give us a call, 844-878-1293.
Jerry, like I said, quick break. Folks, call right now so you can get your own on-track review, 844-878-1293. More of what retirement means to you. We got a report from Kiplinger's, 3 reasons why you might run out of money in retirement, and Jerry will answer them and give you solutions before we wrap up today's program right after this break.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to What Retirement Means to You with Jerry Means. He's a financial advisor and founder of the Means Financial Group right here in St. Louis. I'm your host, Spike Spangle, talking about news and noise, the kinds of things we hear about retirement planning. And I don't know, I see these kinds of articles all the time. This one was in Kiplinger's, 3 reasons why you might go broke in retirement. Are these articles helpful to retirees? Because, I mean, it almost makes me nervous just reading the title.
Yeah, I mean, it sells magazines, right? And I think there's good points in there, but it's just kind of a gloss over, right? So my goal is to help people solve those problems and make sure that they don't have those fears when they're in retirement.
Okay, well, what are the first ones they had? And there's you're taking your money completely out of the stock market as you get to retirement, or you leave too much in. Which do you see more of?
I see people leaving too much in, having too much risk. You know, and not only just having too much in, but having the wrong risk or the wrong amount of risk in their portfolio. Maybe they're invested aggressive, but their tolerance or their need is really more of a conservative or a moderate risk, profile.
Is this more of an on purpose or on accident? Because, I mean, for the most part, we're given those 401ks and we have to make the choices. So somebody thinks that they're conservative, but then when you run the evaluation, you find out they're actually really risky?
I think it happens on accident. I mean, one, you have financial advisors that are accumulation specialists, right? Because we've talked on the show, there's accumulation, preservation, distribution. I like to focus in my business. Of course, I want to help people accumulate and get a reasonable rate of return. But we can do that with an eye on preservation and distribution. But I think a lot of advisors give accumulation advice, and they might even have a client for 20 years, but they've had them aggressive, and they're not making that transition as they're getting older. They're keeping them in that aggressive portfolio. It's not on purpose, but it's maybe complacency, or maybe they don't feel like that client has enough money that, that they're watching it. I get that a lot from clients. They'll say, Jerry, I don't feel like my advisor values me because of the size of my portfolio. And I think that's really bad. I mean, I've always lived by the rule that if you help people, it'll come back tenfold. So it's not really about the size of the portfolio, it's about if people need help. So I think sometimes complacency can do that. The other thing is, again, the last 25, 30 years, we've been in a decreasing interest rate environment. We're now in an increasing interest rate environment. So many people out there have those target date funds.
Oh, yeah.
So they think, you know what, and they understand the sooner that I retire or the lower that number, if it's a 2025, the plan knows I'm going to retire in a couple of years, that plan should be conservative. The problem is they haven't adjusted those plans. Those plans, all they're doing is they're putting more money in bonds, which last year had double-digit losses. I had someone call into the radio show, someone just like you. They came in and they said, I don't understand this. I'm retiring in 2 years. I put my money in the 2025 target date fund, and I lost 22%. How can that be? I thought I was invested conservatively. And again, it was the first year, in the history of the stock market that both stocks and bonds were down double digits. People don't realize, I don't think, how bad 2022 was. I mean, there's only been 4 years that were that bad since World War II. I think it was
where the stocks and the bonds were correlated together, and I think it's
it was the first year they've been both been that bad. But I mean, the stock market itself, 1974, 2002, 2008, and 2022, 4 worst years since World War II. And last year, the first year that both stocks and bonds were down. So I think a lot of it, again, it's complacency by advisors. And I think it's just those plans and those 401ks not making those adjustments. And we've talked, if you're 59 and a half or older, you can do an in-service rollover. You can take your money out of your 401k, put it into an IRA. It's a non-taxable event. It doesn't hurt your employer. They're not going to think you're quitting. I mean, it's there to help them. It actually helps the employer as well because it relieves some of their fiduciary duty because they know they need to have conservative investments in that portfolio to meet their obligation so that you're okay in retirement. So it's a good idea to take that money. And if you have an old 401k, by all means, the handcuffs are off.
Yeah, it's
don't
just been
leave the
sitting
money in that
drifting out
old
there.
401k. And I see people with multiple old 401ks. Don't roll it into your new 401k. Don't do that. Take it, roll it into an IRA, and have the whole entire universe of investment vehicles, whether you do it with me or someone else. Of course, I want to help people, but that's just good advice. Don't leave your furniture in the house that you sold. Take it with you.
Haven't heard that one before. But I think that's incredibly commonplace. People go, well, I'm going to a new job. I'm going to take that bigger 401k that I already have. I'll roll it into there because it's, compound interest, right? It's a bigger amount. You're saying, no, you now have the opportunity to do whatever you want with it.
Yeah, and I tell people once we roll into that IRA, now we can design that bucket strategy. We can look at that written income plan. We know what your emergency fund is. Then we look at what your income need is, what Social Security and pension is going to do, what your income gap is, how much are you going to need above that. Put that much in a safe bucket in the middle to design income. Then we can take money and put it into that third bucket. You always hear, well, if you're 20 or 30 or 40, don't worry about the market, just buy an index fund and ride the roller coaster over time, you'll be okay, right? Well, I like to tell my clients, how would you like to invest like you're 40 and not have to worry about it? Who doesn't want to be, who's 65 doesn't want to be 40 again, right? But that third bucket, if we don't have to do a fire sale on those investments when the market's down to generate income for ourselves because we've already handled that in bucket number 2, you can ride that roller coaster a little bit. Now, we still want to manage the risk and make sure it's the right level of risk for you, but you can invest like you're 40 again.
Well, love to be able to continue to invest like you're 40, but once you get into your 60s, into your 70s, it's a completely different ballgame. And that's what the On Track Retirement Review is all about. Jerry, thank you for your time today. We're going to have to wrap up today's program. Folks, call for your own On Track Retirement Review to evaluate your investments and your risk to help you be and stay retirement ready. 844-878-1293. Thanks for watching. We'll be back next week.